My name is Ted Breyer. I'm a partner at Breyer Capital. We are the lead seed investors in Circle. We're also seed investors in, two other companies here at this event, Hemi and Basilica. I lead all of our crypto and fintech efforts. I'm based in the Bay Area, and I am delighted to be introducing these four panelists today. I'll start with Bart Stevens. Bart graduated from Princeton, went into the hedge fund world, soon became a significant player there. I think he just said, started around 1 million, went to over $1 billion at one point. So he grew a lot. And that was before founding Blockchain Capital in 2013, which is one of the oldest, most active blockchain investors in the industry. Bart welcomed me in his office close to 10 years ago today. And I have made many co-investments with Bart over the last few years. So grateful for that. Thanks for being here, Bart. Bill Tai. Bill has been investing in startups for over 30 years. Bill was originally trained as a chip designer and was employee number 1 at TSMC. And he has invested at the very earliest stage, often the first investor in companies like Bitfury, Canva, Twitter, many others. So, Bill, you've been a long-time friend of my family and excited to continue the collaboration. We have Rob Hadick. Rob is a seasoned finance leader, started his career at Goldman, did private equity at Heritage Partners, became an executive director at Golden Tree Asset Management, where he was overseeing all of the crypto and a lot of the fintech there, and is now a general partner at Dragonfly, a leading crypto fund. And lastly, we have Vanessa Grellet. And Vanessa is a former securities lawyer who spent 9 years at the New York Stock Exchange working with regulators and 5 years at the crypto company Consensus, and is now leading deals from a new fund, Arche Capital. So really glad you can hear from these four today. Let's get into some questions. I'll start with Bart and Bill. You two, we're in the very early days of the industry. Tell us all what it was like to be on the ground floor in the early 2010s, and how might those experiences inform us in terms of where the industry is going?
Well, I can tell you there weren't conferences like this. I want to thank Salt and Kraken, and it's great to be here in the state of Wyoming, who's done some very innovative and kind of workarounds to our current broken system. There's a lot of Bitcoiners here in the state, which is why I'm wearing my Bitcoin sport coat, for the record.
Why is the Bitcoin not on the outside of the jacket? Security is a secret.
Policy. For the record, I have an Ethereum one too for different types of conferences. But back then it was really there was trauma, psychological trauma from the global financial crisis, and we know that Satoshi created Bitcoin to kind of address some of that, because that's encoded in the Genesis block, and there was a just fervent kind of anti-system, libertarian, fight the power, fight the man, fight the bankers vibe. And in many ways, that is the culture of crypto. I like to talk about crypto as being kind of three things at once. It's a new technology, blockchain technology, that enables a new asset class, crypto assets, and there's all sorts of different species. But what really kind of I find fascinating that connects the early days of crypto to today is it's fundamentally, I believe, a political impulse. I think a lot of us in this room believe that the current systems and institutions are broken. They're not serving us in the way that they should. There's regulatory capture and corruption. Our industry has been treated incredibly unfairly, whether it's being debanked or slipping last minute things like SAB 121 or the infrastructure bill that really makes it impossible for traditional financial institutions to engage in the industry. And so back then, I remember the first panel I spoke on, there was a guy to my right who had like really large kind of those whole earrings, and another guy had a mohawk.
Not me, to be clear.
Yeah.
Oh, no large.
And I was in like my blue, Wall Street blazer, and I looked around, I'm like, I'm the outlier here. Like, I'm the one that doesn't belong. So it was a lot of kind of hackers, and I say this lovingly, freaks and geeks and kind of libertarian-minded people that wanted to change the system. And I think that a lot of that vibe in terms of the culture still exists today, and I really love it.
First of all, I'm honored to be here because I feel like, at the age that I'm at, as you mentioned, I've been doing venture now for 30 years. After a certain point, you're always wondering about your relevancy, because having started as a semiconductor chip designer for many decades, that just sort of wasn't important. It didn't seem important, and I'll say also, I went to school with his dad. So here I am on a panel. I started in venture capital years before he was born. And, here he is, anyway, so it's kind of fun to be I feel like I'm like the Highlander of venture capital because I've been around for so long. I've seen so many iterations of things, and there are parallels, I think, to what's happening today. If I clock all the way back to the 80s when I was doing silicon stuff, there were a lot of people that would work on things to drive higher price performance on pieces of silicon that you didn't really know what people would use them for. And if you think about the PC markets in the kind of the mid to late 80s, those markets were maybe 5 to 10 million users in the entire world. So you'd take all of this investment to create these new chips and spend years building this little thing that you'd sell for $20 to make a box that might sell for a few thousand, hoping that some subset of 5 million people would use it, which seemed like a big number at the time. But now, you obviously see product launches with hundreds of millions of users within months. So the scale of things just keeps getting bigger and bigger and bigger. And I think the search for relevancy is always there in the computer chip environment. And then later on, I moved up to computer networking, and I started funding routers and switches and hubs and things like that in the early 90s that later became purposeful for the internet, because it used to be you'd build these little local area networks just in your office, and eventually they interconnected. And same thing, speeds and feeds, trying to find applications. In the PC era, of course, Word typewriters, replacing typewriters with WordPerfect, later Microsoft Word, or calculators with Lotus 1-2-3. Later, Microsoft wiped out everybody with Excel. Internet, the early days of the internet were not unlike this. There were a lot of companies building out all of these points of presence and all this stuff with applications on them that had use cases, but not profit-oriented commercial models that were durable. And there were a lot of instead of tokens, people would spin ads around. So there was a period in the late 90s where the revenue, and I'm going to make some of this up to hide, kind of protect some names, but, I had friends at eBay and, AOL, and they might call each other up one day and say, hey, this quarter, why don't I sell you $5 million of ads, and you sell me $5 million in $1 of ads, and we won't have to exchange any money, but we'll both record revenue. And then the valuations went up to a point where AOL could buy Time Warner. And anyway, so that's kind of where we are today with all this stuff spinning around in the air on infrastructure where people are trying to build faster blockchains. To what purpose? We don't know yet. But I think the networking era reminds me of this in that there was a period in the early 90s where you didn't know whether it was going to be CDDI, FDDI, Ethernet, TCP/IP, Microsoft LAN Manager, Nobel NetWare, and there were all these competing standards for how do you account for packets of data going from one place to another in parallel networks that did not interchange until Cisco came out with the multi-protocol router, and then some of these things could interconnect. And it was quite a while before there was standardization around TCP/IP. So back in 2010, when I first saw kind of like, whoa, this is kind of cool, and then I think my silicon background, having been a little bit outdated at the time because no one else in venture understood silicon anymore because they had all left, I funded the ASIC that became Bitfury. And what I saw there was there eventually would be an application for these blockchains that looked a little bit like TCP/IP for assets. So if you think about how these internetworking protocols work, you have a little, kind of a marker that marks the data and knows where it came from, where it's supposed to go. And I thought, it would be just so much more efficient eventually to get rid of land titles and all these other things, serialization of currency, and just have a digital locator that always knows where it is in a context-aware cloud where the cloud itself knows where every endpoint is. And that is where we are today. The technology does exist. You can route and indelibly where stuff is. But we're just waiting for that, Lotus 1, 2, 3 moment, whatever it is. But I think it's going to be there. Just a question of when.
I love it. All right, Rob, turn it to you. As I said, you spent a number of years in traditional finance across, all areas of finance, and coming from Golden Tree, you had obviously been spending a lot of time in the crypto world and the fintech world for years. What surprised you about joining and then managing a leading top-tier crypto fund?
Yeah, so and first of all, I want to thank all for having us, and that was a tough, act to follow. So I will try to do my best. Listen, I don't know if it surprised me, but I think one of the things that's true and that I continually tell people when we recruit new talent and when we bring people from other financial institutions is that this institutional quality process and the way you might have been trained as an investor when you were younger, when you went through these large institutions, that's not actually just portable to what we do, right? And we see, and maybe this is controversial in this room, but I think a lot of the reasons that some of the blue chip investment firms who have entered the space have not particularly done well relative to those of us who have been in the space, more deeply and for longer, is because it is a different asset class. Like the liquidity profile is different. The time to development is different. The surface area of risk and attack is different. The open source nature of what we do is different. And you have to have a breadth of understanding of what's going on, but you also have to have deep understanding of the core infrastructure and the core technology. And so you need research, you need technologists, you need to be able to understand what is happening on the technological side, and then you need to be able to meld that with institutional quality process and investing and understanding the why and the how and the why now and the who. And when you can bring those things together, I think that's what makes the best investing processes in our space. But if you're not able to do that, and if you're not able to be that deep, if you're too much of a generalist, then it's much, much harder to be successful in our space. And so I think that's something that I took from being I was across all areas of fintech for many years, and then looking at everything in crypto. And I realized, I think pretty quickly that if you want the best returns, if you want to be the most thoughtful, if you want to be able to be the best performing, that just doesn't work in the same way. And you have to get that deepness. And so that's what I think is something that especially like the really deep crypto native firms do really, really well. And people have been here the longest, like Bart. And that was really beaten into me, I think, for the last few years that I've been investing in the space.
Great. Vanessa, what is it like to found a crypto venture firm in the year 2024? How might it be different than when Bart and Bill got started over 10 years ago? Where is it easier? Where might it be more challenging?
I think, and thanks for having me, I think the infrastructure and the liquidity and the talent that's in the space is obviously very dramatically different than the beginning of the 2000s and 2010s. I think, we have amazing professionals to help run infrastructure for funds, for crypto hedge funds. It's very different than running a traditional VC fund. You have issues around custody, you have issues around security, you have issues around reporting that are very different than just running a traditional VC fund. So I think the infrastructure, especially in the US, is amazing. The talent and the knowledge to help you develop a firm is really there. Secondly, you have an amazing breadth of investment opportunities. So you can focus on VC, you can focus on liquid, you can do hybrids. There's tons of opportunities in the market. There are amazing entrepreneurs, first time, second time, third time entrepreneurs now that have experience over almost 12 years in the markets, in open source, people coming in from TradFi, people coming in from Web2 to build. So amazing opportunities there. And then on sort of the exit and liquidity, I mean, if you were trying to exit your positions back in 2015 or 16, it was a different story than today. So I think that's the amazing opportunity that we see. In terms of challenges, I think everyone now is a VC in crypto. So there's a lot of noise and differentiation issues. But I think if you're very focused on your thesis and you have a particular perspective on the market, you can be very successful.
Yeah. On the point of competition, we heard from, I believe, 2 panels ago, Kyle Samani said, crypto venture way over allocated relative to liquid. How do you, each of you, think about the competitive landscape in crypto venture? How do you think about, differentiation, especially when pursuing very sought after opportunities?
Yeah, there's a lot of ways to approach investing in crypto. People have different feelings. We invented a structure 8 years ago that's become an industry standard, which is we'll invest in the equity of the company and also the FDV or the network at the same time. So you're establishing 2 valuations. It's usually about 2 to 1. So if it's a $100 million equity valuation, $200 million future network, and then it takes a couple of years to build the network, whether it's a layer 2 scaling solution in Ethereum or some new NFT project or a Web3 project. And we do that for a couple reasons. Value accrual can be difficult. Sometimes value will accrue more to the token or to the equity. Or if you just invest in the token, that's saying the equity team can spin out 2 or 3 projects, and then you got to reinvest in those. And I'm like, we ran into that problem once, and I was like, well, we've been paying your salaries for 4 years, and now you're telling me we need to invest again for your second token?
Seen that a few times.
Yeah, so we've learned some tough lessons along the way. And I'd echo some of the comments earlier too. What's so exciting and vibrant about this industry is the human capital. I mean, these are people, young computer scientists, experts in distributed systems, cryptographers, engineers that want to put a dent in the universe. And there is a passion and a level of human capital that is super exciting. When I was graduating from college, pretty much all of my classmates were going to McKinsey or Bain, or they were doing management consulting, or they're going to Goldman Sachs or Morgan Stanley's analyst program. And instead I went to E-Trade because to me it looked like the kind of next generation of finance. And so, listen, there's lots of strategies. A lot of people like trading strategies. It's not what we do. We're kind of a traditional venture capital firm. We hold tokens and equity, and we really dig in and try to help our companies grow. To use a video game analogy, we coach them up and we try to get them to level up. And we have a regulatory and compliance practice. We have on-site, we have a staff of engineers that we can, drop into a portfolio company to help them prior to a TGE event. We spend a lot of time on policy issues in DC. I think we're really at a critical juncture as an industry. And we go on boards. So the venture industry, as described to me by one of my mentors, is sourcing. You got to make sure you're seeing the right deal. Selection, invest in the good companies, not the bad companies, but also stewardship. And it's that last one that I think there's room for improvement in our industry. A lot of firms are kind of in there for the quick buck, for pre-token launch, and they're not in it for the long haul. And I think all of us, no matter your style of investing, should be driving towards an enduring, sustainable industry, hopefully with fair regulations, because there is trillions and trillions and trillions of dollars on the sideline that's just waiting for some clarity. I sometimes go in and I'm pitching these very conservative organizations like a bank or a sovereign wealth fund, and they're like, well, Bart, why should we have any crypto at all? And I'm like, I think it's super irresponsible to have zero exposure. We're like, so let's talk about, sizing of a portfolio. And if you want to buy Bitcoin, fine, or Ethereum, fine, or if you want to invest in, one of our funds, that works too. But this is the fastest growing asset class in tech in history. If you want to look at Bitcoin or Ethereum and all the related companies like Kraken and Coinbase and Ripple and Anchorage and others, disclosure, I'm an investor in all those companies. It got first to $1 trillion, faster than Meta, faster than Google, faster than Apple, faster than Cisco. And this industry is here to stay. It's not going to be uninvented. It's global. And the United States is at risk of screwing it up with just overt, hostile regulatory approach. And I'm really grateful for Senator Lummis in the state of Wyoming, who's been a real pioneer here. Her staff in particular has done the work. But this has to be a bipartisan effort. It is not the job of unelected bureaucrats at three-letter agencies to pick winners and losers in technology. That's what the private sector is for. And that's what people like us that allocate capital do.
Bill, what about you? You've been in it for a long time.
Yeah, my model really hasn't changed. I kind of ported traditional venture model over to crypto, and my kind of philosophies don't change. And I'd say I was very influenced by the very first startup I was in, which so old you guys don't even know what it is, called LSI Logic, and it was in the mid '80s. And we had two board directors who were pioneers in venture capital. One was Tom Perkins, who had founded Kleiner Perkins, who they were on their second fund, and Don Valentine, who had founded Sequoia. And Don was on the board, and I had to meet with them to learn a bunch of stuff about marketing. So when I went into Venture in 91, I kind of tagged along with him, and he shaped a lot of how I evolved and thought over time. And Sequoia obviously has emerged as the giant of venture capital, and just Don himself was the backer of LSI Logic, Electronic Arts, Cisco Systems, Oracle, Apple. So you can see probably $4 trillion.
No, Apple at 32 cents.
He did.
Dusted them.
Yeah. He had a fight with Jobs. He didn't like the management, but it was his.
He's a legend. No disrespect.
Yeah. So I did get stuck in an airport with him once. We had funded Microchip, and at dinner I was like, "What do I have to do to be good at this, Don?" And he's a very concise person. If you'd ever met him, he's kind of rough and doesn't like to talk a lot. And he's like, "It's very simple, Bill. You only have to get three things right: markets, management, capital, in that order." And so I was pressing him on that a little bit more, and he's like, "Well," and now times have changed a lot, because in that era, a lot of the companies that you back were asset heavy, building fabs and things like that. So you'd say, well, you got to pick the right market at the right time, and you swap the people in and out till it works. Okay, so now that's changed a bit. So now I focus much more on who the founder is. But
you hear that, everyone? If you take Bill's money, swap in and out.
The markets, the market dynamics have changed a lot. But I think he further went on to say, you could have if you take markets management capital, is that if you take the best team in the world and infinite money and apply it to a market that didn't exist, you will lose money every time. If you get a great market that's a sucking sound, you can put anybody in it and the boat's going to float, but if you get the right team, you might win that market, right? So it's those two components that make the most in the variables of, what can get you off the ground. And then the capitalization, if you go into capital heavy industries, you're going to face dilution unless you stay with it. But, you try to find less capital intensive businesses at the margin if you can. And I think over the long term, if you look at the value creation, everybody understands the power of law. You have this portfolio of things. A few things make all the difference. And so being able to free up bandwidth to focus on those couple things that if they're like, you feel like they're going to go, you can help them really go. That is a big variable in, long-term outcomes. So that, I think, is a function of team values and culture. So, and the people, I know there's some companies in the back, you guys know, I spend a lot of time with the teams on what are your values? Is it a mission-driven culture versus a mercenary culture? And what makes people on that team wake up and go to work every day? Because you get a lot more productivity when people are mission-driven and believe in what they're doing than a bunch of high-paid, good resumes that you throw into a bucket to try to engineer a solution. So I think it's all those things, and I think it's kind of it's a signal to noise thing, right? Because if you got the power of law, sourcing matters, so you got to be in enough of the flow that you see it. But I think being able to not work very much on too many things. Warren Buffett always says the difference between somebody that's good and really great is the person that's really great says no to almost everything. And the couple of things they work on are giant. So I try my best. It's impossible to do that every time, but that's how I try to run my life. Few things, big possible outcomes. Values, culture, people.
Hit it, Rob. The other thing I might add, one, I would probably disagree with Kyle that liquid or venture is ever allocated. I think people respond to incentives. LPs respond to incentives. If their incentive structure, or if there was returns in the liquid market relative to the venture market, the capital would be there. It's not the other way around, right? And so this is because the opportunity is so great. That's why it's evolved the way it has. I think we're going to see fund consolidation in venture, and we're starting to see that already, and shrinking fund sizes, et cetera. But I don't think on a relative basis we're not over allocated. I think broadly agree with a lot of what Bart said around portfolio support. The whole space, the venture in this space has gotten more competitive. I think people have started to realize, if you look back to other cycles, there was a lot of club deals. Like, someone would announce a deal and there'd be 50 investors. And they'd be like, this is great because every good investor is in the cap table. And then those founders started to realize that none of those investors gave a shit about it. Like, they picked up the phone, there was nobody that would call them back. And also the investors started to realize that I actually do need an appropriate level of ownership to care. Right. And so what's happened is, in a way that, Web2 venture already was, is we started to see people, and we've done this, is care about what my ownership will be. Do I have a big enough check? Like, does this make sense for my fund size? And so that has gotten more competitive. I think portfolio support is part of it, and branding is part of it, hiring is part of it. Though one other differentiator that I think we pitch a lot that is that this space it's global. Like, it is borderless, permissionless money. And a lot of venture over the history of Silicon Valley has been really insular, and I think doesn't have a global outlook. We have, half the team is in Asia. We do everything through the lens of, what will the global markets and how will they react to this? And I think that allows us, and with our connectivity in those other markets, allows us to differentiate for a lot of even founders here in the US who want to reach those markets.
So I'll add my favorite quote from Peter Thiel, which is, competition is for losers. And it applies for companies, but I think it also applies for VC funds. And if you find your niche, if you're specialized, if you add value, if people know you and want to come to you for that specific thing, you'll be very successful. So we come in at a very early stage, pre-seed and seed. The other GP in the fund used to run the incubator program at Polychain, where he incubated projects like BitTensor. So coming in very early, finding a founder who wants to build something, just has an idea, and helping them build that. And I think that's differentiated enough for us to be able to work with funds that come in at a later stage, who do the global distribution, et cetera. We also focus mostly in the US. We still think that the bulk of the talent, the technical talent, is so deep in the US, working with PhDs from universities. I was just at the Stanford conference. It was just amazing. And so we want to focus in the US in an environment that, despite what's going on the regulation side, is really favorable to innovation and this specific open source development, and has the culture of that. Despite there being global opportunities, that's where we want to play.
All right, I'll fire a question at all of you. in terms of mistakes made over your investing careers in crypto? It can be in traditional tech as well. What are some of the key lessons that you've learned? How is that informing your ongoing investing strategy from here?
Boy, we've learned a lot of hard lessons over the years.
Done a lot of good deals. Probably missed a few.
Integrity really matters. And humility really matters. That's the culture at Blockchain Capital. We want to be in business with founders that are mission-driven. The technology of blockchain technology has inherent values built into it, and those values are reflected in the culture. And it's open source composable software, it's privacy, it's freedom, it's censorship resistance. And if a founder is in it for the quick buck, if they are not a missionary, it's usually not someone that we're going to back. And we've made some mistakes along those lines where, it was a kind of shorter walk-up, let's say, and they wanted to do kind of a really quick coin TGE event, and then poof, they're gone. And there's been some bad behavior. We're all aware of the scandals that had beset our industry. We're still kind of digging out of that hole. And so making sure the founders are aligned with the values of your firm and also the values of crypto culture, which itself is reflected in the inherent nature of the technology. And so that's been a big learning for us, is that the founder matters, especially early on at pre-seed and seed. I think superstar founders can have a disproportionate impact on the business. If you're doing a Series E financing, it's probably a little bit less important. And you also have to be there's so many ways to go wrong in crypto. I think Bill said it earlier. You don't want to be in a generalist VC fund that's dabbling in crypto. This industry moves too fast. There's so much nuance. There's technical breakthroughs left and right. There's a regulatory minefield that you could get your leg blown off on. And so what we've seen is the best entrepreneurs, they want to work with the crypto native firms that help their business grow. As good as Sequoia is, I would say the top tier crypto VC firms just run circles around those guys. And I have nothing but respect for Sequoia. And fund size matters. I think smaller funds are appealing to both founders and LPs. It's all about alignment. So if I'm pitching a competitive deal against a $5 billion fund, and I'm like, hey, mine's $500 million, and I'm writing you a $25 million check, I'm going to swallow glass for you. Like, this has to work. I'm on your board. We're going to get this done together, come hell or high water. Where if you're, $25 million position in a $5 billion fund, they can just write that off. It's no big deal.
Yeah. Bill, you've done Zoom, first check, Canva. That just means you've missed a few, right?
Oh, I've missed a lot. I turned down Steve Jobs on Pixar, I turned down Elon on Tesla, So when I make those kinds of mistakes, it's what there's a phrase for, like, when you have you're wrong negative.
Anti-portfolio?
The anti-portfolio is big, because I think I feel like I have to bond with somebody's, culture and values. And some entrepreneurs are so mission driven, I don't understand it, because I think it's like, I don't believe them in some ways, So I think I've missed those, but I'd say if I have mistakes, it's usually my judgment wasn't quite right about the person, and or my timing was off on the market. Because I think there's this phrase, Woody Allen says 80% of life is just showing up. I say, well, but it's kind of showing up at the right time. And so I think timing matters so much, because if you're trying to surf, if you're too far in front of the wave and you're paddling really hard, all that happens is you get tired, and your team jumps off the board because they're tired. And then you see somebody else that got up at the right time to scoot right by you. So picking markets that are sizable and trying to figure out when to enter or how to moderate the burn rate, because you got to be ahead of the wave, but you can't over invest and have a high burn until it's time. So you got to kind of get that product market fit right before you juice it.
Yeah, maybe super quickly to add to those. In most parts of crypto, not all, most parts of crypto, distribution matters as much, if not more, as the technology itself. So technology is a threshold. You meet that threshold. The ability for the founder to storytell, the ability for the founder to go to market, to do business development, to distribute, matters, as much, if not more, than the tech itself. And I think at times one of the mistakes that we have made has been saying, okay, well, this is just amazing technology. We really believe in this. And then it comes time to go live and to actually find product market fit in those customers. And the founders have no idea what to do because they're deep, computer scientists and researchers. And so that's one area where I think we've taken a lot of learning and how we think about going forward and he'll be back.
If I look back, I think investing as early as possible, as much as possible, with as much conviction as possible, and really thinking about portfolio construction. This does not change from traditional VC, even though, there's nuances around the token versus the equity. The power law still plays out in crypto. So you want to make sure that you have the right check size at the right stage for the return for your LPs.
Wonderful. Well, thank you all for this great conversation. And thanks everyone for being here.